You know, what's the most revealing thing a company can tell you without actually saying a word? Well, it just might be what it does with its profits. Seriously, this one decision can tell you so much about its health, its confidence, and its entire game plan for the future. So let's get right to it. Imagine a company has a great year. It makes a profit, the cash is sitting in the bank. Now what? That really simple question is where one of the most complex and honestly one of the most important debates in business really begins. And this is what we're going to call the profit dilemma. It's not just about spending money, right? It's about choosing a path that's going to define the company's entire relationship with its owners, its shareholders, for years to come. When you boil it all down, there are really just two fundamental choices. On one side, the company can pay out the profits to its owners, that's the shareholders, as dividends. That's their reward for investing in the first place. Or, on the other side, it can reinvest that money right back into the business. We call these retained earnings, and they're the fuel for growth, R&D, and expansion. So, pay it out or plow it back. That is the dilemma. Okay, so let's say a company decides to pay out. It's not as simple as just, cutting a check. They've got a whole toolbox of methods they can use to get that value back to the shareholders. Let's open it up and take a look at the main tools inside. All right, first up is the stock dividend, which you'll also hear called bonus shares. Now, here's the clever part. Instead of paying out cash, the company just issues more stock to its current shareholders. The cash actually stays inside the business, but now every shareholder owns a bigger slice of the pie, or at least more slices of the same pie. Let's look at how that actually works on the books. So imagine our company starts with 10 crores in capital and another 10 crores in its rainy day fund, the reserves. Now look what happens after the bonus issue. See that? 5 crores just gets moved from the reserves column over to paid up share capital. All that's happening here is the company is turning its saved up profits into formal owner's capital. The key thing to notice? The total net worth doesn't change by a single rupee. It's basically a smart accounting move that rewards shareholders without the company having to spend a dime of its cash. Next up in the toolbox, we've got the stock split. Now, this is a little different than a stock dividend. With a split, the company increases the number of shares out there to deliberately make the price of each individual share lower. So why would they do that? Well, the goal is pretty simple. Make the stock more accessible and more affordable for more investors, which can really get trading activity buzzing. And again, the company's total value doesn't actually change. And the final big tool in this payout toolbox is the stock repurchase, or what we usually call a buyback. This is exactly what it sounds like. The company uses its cash to go out and buy its own shares right off the open market. This reduces the number of shares floating around, which means the ownership stake for everyone who holds on to their shares goes up. It can also give a nice little boost to the earnings per share. It's just another way to return value without that traditional dividend check. So, with all these different tools available, how on earth does a company decide what to do? Well, the decision is definitely not made in a vacuum. It's influenced by a whole map of internal and external pressures that they have to navigate. First, let's look at the external factors, the forces outside the company's direct control. Think about it. If the economy is booming, maybe keeping that profit to expand is the smartest move. But in a recession, just maintaining a dividend can send a powerful signal of stability. And tax policy is a huge driver. If dividends get taxed heavily, shareholders might actually prefer the company reinvest the money for them. And then, of course, you've got the internal factors. A big, stable utility company can probably pay a steady dividend, no problem. But a tech company whose profits are all over the place, that's a different story. And who are the shareholders? If you've got a lot of retirees, they're probably going to want that regular income. But if there are massive growth opportunities on the horizon, it makes a lot more sense to keep that cash and fund them. So at the end of the day, it's all about balancing these competing needs. Over time, all these little decisions start to form a consistent strategy, and we can really think of them as 4 distinct playbooks that a company can follow for its dividend policy. Okay, first up, we've got the stable rupee dividend. Just look at this graph. That top line, the earnings per share, or EPS, it's bouncing all over the place, right? But look at the bottom line, the dividend per share, or DPS. It's a flat, straight, predictable line. This strategy is 100% about stability. Think of a huge, established company, maybe a national utility. Their investors often rely on that steady, predictable income. So for them, predictability is everything. It sends a message of pure reliability, even when the company's profits go through some ups and downs. All right, next up is the incremental dividend policy. With this playbook, the dividend line isn't flat. It looks more like a staircase. It moves steadily upwards over time, step by step, even if the company's earnings have a few bumpy quarters along the way. This playbook signals one thing above all else: confidence. Management is basically telling the market, hey, we're not just stable, we are consistently growing, and we fully expect that to continue. That is a really powerful message for attracting serious, long-term investors. Now, playbook number 3 takes a totally different approach. This is the stable payout ratio. Notice here how the dividend line is practically a mirror image of the earnings line. When profits shoot up, dividends shoot up. And when profits take a dive, well, the dividends fall right along with them. What's happening here is the company is committing to paying out a specific percentage of its profits every single year, let's say 40%. This directly ties the shareholders' reward to the company's performance right now. It's definitely more transparent, but it also means that dividend income can be super unpredictable. And our final playbook is the residual dividend policy. Residual is just a fancy word for what's left over, and that's exactly the idea here. You see that jagged dividend line? That's because the dividend is only paid out from the profit that remains after the company has funded all of its new investment projects. With this policy, the priority is crystal clear. Growth comes first, period. The company figures out its best investment opportunities, then it funds those projects with its earnings. And only then, if there's any cash left over, does it even think about paying a dividend. This is the classic playbook for a high-growth company, like Amazon in its early days, where reinvesting every penny for the future is the name of the game. So after looking at all these choices, these tools, these playbooks, what's the big takeaway? It's that a dividend is never, ever just about the money. I really want to land on this quote because it just perfectly captures the essence of everything we've been talking about. A dividend decision is communication. A rising dividend signals confidence from management. A stable dividend signals reliability. A surprise dividend cut can signal that there might be trouble ahead. It's a direct message from the boardroom to the entire market. So the next time you see a company announce its dividend, don't just glance at the number. Ask yourself, what playbook are they using? What are they trying to tell me about their future? A company's dividend is its promise. The real question is, what are you hearing?